In this video, I'm going to talk about the challenges of the Indian banking and finance sector. In India, households account for the bulk of savings in India with more than 50% in physical assets. The Indian finance is divided into four aspects: currency, bank deposits, loans, and bonds. All of these together form the Indian financial markets, which is further divided into three. First one is money and banking, second one is capital markets, third one is insurance and retirement benefits. In this video, I'm going to be focusing on money and banking. So what is a bank? Simply put, a bank is a financial institution that takes in money from its depositors and lends that money to the borrowers at a cost higher than the cost it takes to get the money. The difference is the bank's profit. To start a bank in India, you need 200 crores in paid capital, 300 crores in authorized capital, a cash reserve ratio of 4% of the net time and demand liabilities. This should be stored with the RBI. A statutory liquidity ratio of 18% as of April 11, 2020, and it should follow the Basel III norms, which has capital adequacy ratio. More on that in a minute. 25% of the branches should be in non-urban areas and 40% of the lending should be in priority sectors, that is agriculture, education, self-help group, etc. So the health of banks in India has been good for most of history, but in recent times it has actually taken a beating. So according to Anuvin Panagriya, the two key factors of the health of a bank are CRAR, the capital adequacy ratio, and the elephant in the room, which is non-performing assets. Now, CRAR, the capital adequacy ratio, has been an issue for a long time, but because RBI is now following the Basel III norms, every bank is required to have a minimum capital of 9% in liquid cash. To follow the Basel III requirements, RBI has mandated all banking institutions to say that. Now, given the current crisis, I am expecting the capital adequacy ratio to increase in further. Now, let's talk about the elephant in the room, NPA. An NPA, as defined by RBI, is an asset, including a leased asset, that becomes non-performing when it ceases to generate income for the bank. Now, for an asset to become an NPA, there should have been no principal or interest payment for 2 quarters, that is 6 months. Now, NPA are classified into three. You have substandard assets, which is an NPA which has been for less than 18 months, doubtful assets, which is an NPA for greater than 18 months, and loss assets, which pretty much RBI and the bank has washed their hands of it and they don't think they're going to recover the money. India is going through a serious NPA crisis. You have the ILFS, you have Yes Bank, you have so many other financial institutions, the JP Group, a lot of real estate companies have all become NPAs and have become very costly for the Indian economy. So now this is not because the banks are less productive. So the Indian banks, the productivity is measured in the amount of business each employee becomes. That has been steadily increasing across the board. So it is not because of decrease in capital infusion as well. My opinion is that it is because of the risk and market volatility. So what is the solution? So RBI has tightened the scrutiny, RBI has tightened credit growth, RBI has infused capital, RBI has encouraged public to invest in such banks by disinvestment, and RBI has merged banks, which I believe is actually a window dressing and does not solve much of the problems. However, these problems are all policy changes. What we need to tackle the problems are structural changes. So my idea is that the risk of default should be stopped with the financial institution, should be contained within the financial institution and should not spread to the other part of the economy. So for this, I have a few solutions. The first one is profit loss sharing. So this is a concept that has been pioneered, and this is like basically you are an investor. The bank becomes an investor in the business. The bank could act as investors and it could give loans. So if the company makes a profit, the bank takes the profit. If the company does not make a profit, the bank suffers the loss. This loss is not forwarded to the RBI. This loss is contained within the depositors. So a challenge would be here is the cost of capital, the weighted average cost of capital. RBI could enhance this by RBI could enhance this method by increasing the cost by decreasing the cost of capital by adding the interest tax shield to the profit available. To circumvent now, the banks could also move from asset weight models to asset light models. So instead of buying assets on loans, RBI could encourage companies. A lot of companies have come in which companies can operate on an asset light model. So for the financial institution, it will be a steady flow. The cash flows will be sorted because the assets are either on lease or on rent. Whereas for the company that is taking the asset, for them, the operating leverage is decreased. As a result, the operating risk is lower now. Now, let's talk about the most important concept, that is farming. Now, agriculture, as I said before, is a priority sector, and RBI mandates priority sectors to be a lot of lending for the priority sectors. But clearly, this has not helped because farmer suicides have been increasing by the day. I don't believe that the minimum support price is the solution to go. Rather, you should isolate the farmer from the risk of drought and market volatility. For this, you can have two solutions. The first one is through a futures contract. So instead of giving loans, you can give support to any other, not just in money, you can give any other support and buy the produce. You can have an agreement with the farmer saying that you're going to buy the produce at this particular at this particular cost. The second one is like a manufacturing contract. You based on the farmer's assets, you can say the farmer needs to produce this many quantities of this particular thing, and the financial institution will buy it and flip it over for a profit. Now this cannot be happening in banks. So as a result, the RBI should encourage NBFCs to take up to prioritize agriculture. It has been clear through Anavin Paragria and among other studies that the priority lending has not helped. It has not helped either the banks nor the sectors. So you can innovate the business models by NBFCs and not through banks. So I believe that the farming problem and all the other problems with NPAs related to business are not economic problems per se, but they are problems that can be very much solved using business models. So this is not a finance problem, this is a strategy problem. So I hope that this video gives an alternative perspective on how our problems are. And for further reference, I suggest two books. The first one is Muhammad Yunus's The World of Three Zeros, the Nobel Prize winner. And second one is Fault Lines by Raghuram Rajan. Both are brilliant reads and they deal with the issue of poverty in detail and the importance of credit in a developing economy. Thank you.